Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, June 6, 2025. What I'm going to do in this video is start out here. I just threw out this trade idea for you with an update on Bitcoin as well. So I'm going to start on that, talk to that, and then we're going to roll into Treasury bonds and the stock market, but I won't do a super deep dive because there's not a lot changed in the posture of the stock market, but I do want to cover a couple sectors that weren't watching. And again, what I literally cannot emphasize enough is Treasury bonds. So I'm going to get to Treasuries, start there, then look at a couple other sectors. Basically, we'll look at the retail stocks, transportations, and the financials. So that's what we're going to do in this order. On that RIOT trade, it's straightforward. For any of you that held out for T3, that was a trade entered right here at the low. We got long Bitcoin, bullish Bitcoin, Ethereum, all these cryptos. Been a nice run up there. That's about, what is that, about a 63% gain, 65 actually from the lows. So congrats to anyone that caught it. Time to reverse. It's, typically my final targets are at a level where the trend reversal ends. That's why I list those. Sometimes, not always, but in this case, I think it will be for the reasons cited. Negative divergence here on the daily chart. If we step down, let me pull this down just a bit here, get this in view here. Click on a 60-minute chart. You can see we're at resistance, more of a resistance zone. Got pretty nice resistance right there at 1013. We have that reaction high there, some reactions there. And I also have it running up. So it's more of a zone that runs from about where we just hit about 1013 up to about 1073 with negative divergence on the 60-minute chart. So that's it. Now on Bitcoin, as I updated with you there, we have this whenever that chart was, I just gave you the chart. I give you a setup with a sell signal to come on Bitcoin. This is BRR Bitcoin futures right there. Sell signal coming to break of the trend line. So and that was the first price target. Remember, I gave you the charts here, right there. And as I mentioned in there, I just want to clarify futures. If you trade futures, you know this. Futures continually roll. Some roll quarterly, like the indexes. These futures, I'm going to roll every month. And that was the May contract. So when you look at my targets, they're at the same levels. This was what I posted back on May 23rd. And so that's the levels just hit. In fact, as recent as yesterday, let me just go to yesterday's video right here. You can see, let me make this a little bigger if I can. This was in yesterday's video, was my last update on Bitcoin. And I highlighted these targets right here. I just added, this is the drawing. This is just a screenshot from the video. You see
Up on that first.
It's me targeting this support zone, highlighting it. And that runs down, what is that, 99? Well, here, I'll go to the live chart. Same levels I gave you. Nothing's changed. That was just yesterday. I had it at 99,657. That's about as perfect a tag as you can get right there. You can see this candle was hit last night. I always talk about having your buy to cover limit orders to set outside of regular trading hours, especially if you're trading futures, guys. That's why I typically don't use ETFs like IYT, IBIT. I do it for those of you that don't have futures accounts, but if you trade futures, this is the actual crypto. So basically a perfect tag at the bottom of my first target zone, and that's the sell signal came. I put double lines here because they have parallel trend lines. This was the main trend line, and then I had the BOD right there. Benefit of the doubt just below it. So whatever, good job. And so that's it. And then as I showed you on that chart, I'm drawing it in right now. I'm hand drawing it. Here, let me actual draw it in. So for those of you that are active traders that covered last night, let me go back to the futures. And this is it. You hit the first target right there, bounced, and had a little overshoot on the futures. But remember, on the actual crypto, I had that double lines, the support zone. So we had a perfect tag at the bottom of my support zone. Bounced as expected upon the initial tag each of my targets. Typically you get a reaction, and we bounce right back to the downtrend line. Doesn't get any easier. That either works or it doesn't work. So you take a shot. If you're on the same page as me, that's a sell signal there. First leg down, counter trend bounce. That's my next target, and then my next target after that. So and then my point being that crypto, if you're not aware, RIOT is it's a crypto, what I call proxy. It's going to move in line with crypto. It's not mere coincidence. I went bullish and long both Bitcoin, Ethereum, and RIOT down here. and had a target that coincided again, just hit. And that RIOT, that final thrust, what I was conveying to you in that post this morning, this little reaction off my first downside target, we're on a sell signal, coincided with that final thrust up in RIOT. So that's kind of how my mind stitches things together. And like I said, it's, we're in an uptrend, counter trend trades. That's what I do. That's my thing. Most probably didn't want to buy Bitcoin or right back here, and most probably don't want to short it here, and that's fine. I always say take trades that you're comfortable with, that mesh with your trading style. And of course, if we go much above there, that's going to be a breakout of pretty solid resistance. But again, reactions most likely at this point. There's a potential downtrend line if this trade gets some traction. Really nice downtrend line. So if you are bullish in a long RIOT, then and you think there's more upside, that would be a great target. You can see it comes in right with that 1466 resistance level that I have right there. Okay, enough on that. Let's get to the good stuff, what I think is the good stuff. I'm going to start with treasuries, and then we'll get to everything. Well, let me just look at QQQ. Let me just pop over there. QQQ and all these indexes. Remember, I had these uptrend lines here, which broke, gave us a sell signal, but with the one thing lacking that I really love to see on a daily chart, as you guys know, are divergent highs and lows. So we didn't have that then. We had a little pullback. We hit our first target on the QQQ short trade, had a little counter trend bounce, and that's where we're at now. So now we do have just about every sector and index I look at, we do have negative divergence now in place on the daily chart, meaning the momentum indicators down here, the PPO and RSI, are making lower highs with prices making higher highs. And you have these secondary downtrend lines or wedges that come into play. And of course, we're in spitting distance all-time highs, like I told you last few days, like I told you before we even took out the 200s. If we got there, there is that kind of gravitational pull. We're in spitting distance of all-time highs, but we're in spitting distance of multi-decade highs as well, and all-time highs or multi-decade highs in treasuries, which I'm going to get to in a second. So again, that's the quick update in QQQ. Not a whole lot changed there. On the 60-minute chart, you can see we're still wedging up. This is what it looks like if you want to replicate this, and I would highly encourage to set a trend line. I don't know if we're going to get that today or not, but that's that bearish rising wedge. It's been building now. Oops, I need to just take this line right here. That's my divergence. Remember, we didn't have, at least not on the RSI. We started the divergence on the RSI at this point here, and that gives us just a textbook bearish rising wedge. So bear with me. Let me get to treasuries real quick. Before I do that, I'll just, to be comprehensive on the equity market, show you what SPY looks like. This is SPY, the S&P 500, again, still off the highs, not far from them. I've already commented on that. Coin toss odds, whether we make a marginal new high or not. Again, I believe it'll be marginal, meaning slight, very few percentage, less than probably 5 percentage points above, or we fall shy, like we did with the NASDAQ back in the beginning of 2022, after peaking in late 2021. So, and you can see we're already below on SPY, unlike QQQ. In QQQ, I had that textbook wedge, and we're flirting with it right now. So we're on the, again, close to, but not yet below the trend line. But on SPY, we broke down, we're back testing right there. And so close. A breakdown, but as I always tell you, the reason I watch both of these, even if I'm only trading one, is because if one breaks down, which it did here, SPY, and the other doesn't, which is QQQ hit and held trendline support right there, that secondary trend line right here, then you need to see the latter of the two, both of them break down to give you sell signals. And then, of course, you have small caps, which are really... and again, this is going to be the common theme when I get to the fixed income right now. A lot of these things, especially the small caps. Somebody asked me the other day, "Hey, Randy, I thought you said small caps were more sensitive to rates." They are. That's not my opinion. It's not some esoteric kind of concept or unproven theory. It's a known fact. They're much more dependent on borrowing, and higher rates hurt them. And we're pushing at a multi-year, and possibly even multi-decade highs in interest rates coming up, especially on the long bond. That is, of course. And now, don't get me wrong, the bear market is still well intact. The small caps peaked way back then. They're well off the highs, and I gave you an update the other day. I just wanted to mention. So from the bullish perspective, glass half full, we took out the downtrend line. However, there's really nice resistance, as I mentioned right here. And for the first time, you can see this chart goes back, where am I going to? July of 2024 to the left here, the middle of 2024. Since then, this is RTY again, small cap futures, we've only had 1, 2, 3 divergent highs. In fact, you know what, I can add in, I may miss this one here. That was also a divergent high, so 4. So we had that was a double-digit drop. That was obviously a high double-digit drop, and here we are again. And you can see we have a nice clean uptrend line, a lot of reactions. And so, as I told you before we even got here, my views aren't going to change if we still have those divergences intact and overbought conditions. And again, I'm going to get to treasuries, which I think will make or break this rally and determine whether or not we're going to punch to new highs, and whether or not it's going to be only a marginal new high or a lot more. So without further ado, let me get to the TLT and TYX. We'll start with TYX. That's the 30-year. Yes, I'm focusing right now on the long bond. Remember, Fed controls the short end of the rate curve. Really the shortest. Again, money that you and I don't benefit from. They control the federal funds rate and overnight lending rate that banks can borrow from the Fed, or the discount window, then go to each other. Those are overnight loan rates. Again, you and I don't have access to money at the federal funds rate. So what we have access to is controlled more by the bond market, typically the 10-year Treasury bond, which is kind of the benchmark for both 30-year mortgages, believe it or not, as well as car loans and things like that. They're going to kind of track around the 10-year. So we're going to look at the 30-year because that is the long bond. That is one that's going to make headlines. Recently, Japan broke out on their 40-year. That's their longest term bond to new highs. Like I said, we had an abatement, but and unless you're new to the site, I've been harping on this for a long time. We're in we ended one of the most powerful and very well-defined secular bear markets and interest rates, meaning falling rates. Again, this is not my opinion or anyone's. There's not an economist in the world out there, or an expert, or anybody familiar with the stock market and financial markets that isn't aware of the concept that rising interest rates are net headwind for equities, and falling rates are bullish. So no coincidence, we're coming off one of the longest and strongest and most powerful bull markets, and we're still seeing the effects of that. The markets have been extremely resilient to this breakout. This trend has changed. Now, the million-dollar question, I have made the case before it even happened, and many times since, and since it did happen, showing you that we've made now, by every metric and technical analysis, meaning a series of higher highs and higher lows, and taken out the long-term secular downtrend line, that we've most likely begun a new secular bull market, rising interest rates. Now, that's going to take decades. Remember, this goes back to the late 70s, early 80s here. That's when rates peaked. And so the way this thing's going to play out, I can't tell you exactly, but I'm certainly going to try. We could have an abatement that brings rates back, yields back here, and then go up. It can happen in many ways. All I can tell you definitively, and I have been, is we are right now, this is what we're at. We're sitting here. The long bond is, again, I keep using the term, within spitting distance of breaking out to, let me go back to the weekly chart, not just a 52-week high, but as I take this line back, I'm going to do it for you here. We're going to go back. And here, let me go back to that monthly chart. Let's do that instead, so we can go all the way back and kind of give an idea. Again, it hasn't happened yet, and that's when the market is, like I said, and I'll get to in a second, in my opinion, playing Russian roulette with probably 2 or 3 bullets in the chamber right now. What do I mean by that? Because this is, again, I'll get to in a second, we're just a bad day or two away, and I'll explain what that means in a second, from doing this. Because, as the markets are getting close to punching out to new multi-year highs or all-time highs, so are treasuries. And so, as you can see, and as I've covered right here, take that line across, That's exactly where we had pinned. We were hitting pop, pop, pop when the financial crisis began. Remember, that was, and will go down in history as some people refer to the housing crisis was the cause of that, but most experts agree it was a debt bubble, just like Japan's debt bubble that started the lost decade, which was really 2 lost decades in Japan. You can Google that term and read up on the lost decade of Japan. So this is where the kind of the in recent memory. Remember, rates were a lot higher here, so this was falling rates. That was net bullish and fueled the biggest bull market run, secular bull market in history. And I'm just pointing out that this will take us here. Now, if we break out, we've already had this. This is a high-level consolidation. This reminds me a lot of what gold did recently. You look at gold, and you had right here, you had a previous all-time high, the bull market then in 2011, and then you had this high-level consolidation, and then you had a breakout and a powerful move that followed. This is what I think is quite likely in treasuries. I'm not betting the farm on it. It is, again, I continue to say this, it's something very, very much to watch for. And like I said, I think the market's playing Russian roulette because I think that's probably what's going to happen. It has been my thought for a long time. I've drawn out on different boards. I have it, I don't know where it is, maybe on the weekly. Here it is. This kind of line right here, like projection lines, calling for that. We have a divergent high right now, negative divergence. So that means we could just stop. And so far we have. We hit that, kissed that level right there, pulled back. But what I think is a good chance of happening, and again, more important, if you listen to my voice, it's something to react to if and when it does. It may never happen, but it could happen within 1 or 2 bad days. We pop there. You're going to probably see rates spike up. It's going to be a breakout again to new multi-year, even new multi-decade highs. And I promise you it will make front page news. And again, I'll fall out of my chair if it's more than just a brief, 1-2 day pop, and then, we fall back down pretty clearly down below there. That's certainly possible. But let me talk about that when I keep saying, we're a bad day or two away from it. So, as I highlighted back here, the Fed, for the first time in at least modern history since I can remember, completely and utterly lost control of the long end of the curve. Remember, they typically, when they want to spur economic growth, they cut interest rates. Again, they cut the federal funds rate. They don't cut the 30-year bond rate. They cannot cut the bond rate. Nobody can. Bond rates are set by market forces, supply and demand. Fed and the Treasury and the Fed can get hand in hand and certainly try to manipulate it to the best of their extent, but the bond market is massive. They don't control what Japan's doing. They can try and exert pressure on the Bank of Japan and ECB, and they can do all that. But again, at the end of the day, market forces are going to set rates. And we know what's going on with Trump's big bloated bill and what that's going to do to the deficit. So as I pointed out here, we had a trio of rate cuts, and this is the first time, at least in modern history, maybe ever, where Fed started cutting rates on a cutting. This is where they started the cycle, and instead of going down like normally they do, the interest rates went up, and look where they are. They're still up there, and that's one reason the Fed has stepped back. In my opinion, it's like a WTF moment. So that's it. The bond market's speaking pretty loudly now. Now let's talk about when I say that we're a bad day or two away. What do I mean by that? So, well, this is TYX. This is the yield of the Treasury bond. So we're going to take this candle right here. Let me turn off all my lines real quick. So this is when I say a bad day means a high spike in yields. Bond prices go down, but yields go up. So if it's a red candle, my candles are set to show at the close right there. So it's going to be the bottom of that candle. I believe that was it. Yeah, it was at the close. 43.88. Oh, sorry, it's at the right here, the top. Yeah, it's still red close. So there's one day. So in a single day, up to the highs, the yield popped up 5.5.5%, right? And the next day it was up from there about a total of 8%. And there's 3 days right there. 3-day move, given those were, when I say a very bad day, not an average day. Average day yields don't move that much. But so as I'm showing you here, yields they don't often, but they can move up as much as 5%. And again, that's not 5% on the Treasury bond. That's the rate of change. It's a 2.2. You can see the pop-up box to the left. So where we're at today is right here. So if I'm going to pull up 5%, that's what I'm doing right there is 5%. So again, just now, it doesn't have to happen one day, doesn't have to happen tomorrow or on Monday, I should say, doesn't have to happen next week. But anytime, I'm just trying to show you how close we are, which again is technically speaking, just a big move, a single day, anytime soon. Now, if we start to go back down, I made the case recently, there was negative divergence at that high. This is when we tested that previous multi-year, multi-decade high. We had a perfect test of it right there. At the time, we had negative divergences, and and then we went on to break this little uptrend line. However, I told you the other day, I suspect there's a good chance that this breakout, this is going to prove to be a bear trap or a bull trap if you want on TLT. If TLT, just flip it upside down. All right, and this is bond prices. And there it is. And the same thing, you can look at it if you want to do it that way. So there's where we closed that day right there. Next day, we had dropped 4% on TLT. So if we drop 4%, if we have a, let's say next week, that's 3% just gets us back down to lows. 4% will have broken out treasuries to new all-time highs. So here's the analogy I'm going to use, guys. I know I get the comments. A lot of you think this market, and I'll tell you, it's as resilient as I've seen. I understand it looks bulletproof. The technicals are what I go by. I've traded enough markets to know during strong bear markets and corrections, it looks like the bottom's never going to come. It might feel that way. It's called recency bias. And it's just something that that many traders suffer from. Something going up, they're going to just assume is going to continue to go up. And that's where we use the charts. So this is what's happening. The market right now, the stock market is humming along, and ignoring this risk is right now, it's not a risk. Right now we stared off the edge of the abyss, and the abyss stared back. We didn't crater. The yields didn't break down. We saw them pull back. We saw the Japan 40-year yield, come back down. And so right now the markets say, okay, hunky-dory, it's rally time, right? So that's it, guys. We're right on the edge. It reminds me of, I just finished the Dale Earnhardt series. There's a four episode series on Amazon Prime right now. I remember I'm not a huge NASCAR fan, or really NASCAR fan, but I happened to be watching the Daytona 500 when he was killed. We were just finished a camping trip down in the 10,000 Islands. We're coming back eating a little podunk restaurant in Chokoloskee, and they had it on TV. And so, yeah, I remember that. So I watched it was a good documentary, by the way, if you guys are, even if you're not into racing, I thought it was well done. And so the point is, Dale Earnhardt, you guys probably, I'm sure, know who he is or heard of him. They called him the Intimidator. And I think it was in the first or second episode, they talked about how those drivers, especially Earnhardt, I mean, he drove on the edge. He pushed the limit, put a lot of people into the wall, crashed a lot, and ultimately ended up killing himself, or dying during a race, I should say. But the point was, they mentioned in there that when those guys drive, especially Earnhardt, aggressive drivers, the ones that are out front, the ones that are often getting the checkered flag, they're pushing it to the very edge. They're just skating a fine line between spinning out of control and crashing into the wall, or hitting another car and flipping over. And so that's the only way those guys win. And again, is by just riding a very fine line between being out of control suddenly. And if you watch NASCAR race or any kind of racing, it's a split millisecond. Once that car starts going sideways, you tap someone else's back fender, quarter panel, boom, it just happens. That's where I believe the stock market is when you're in this close spitting distance. I wouldn't be doing this video and talking about if Treasury's right here. We could have a setup with a reversal, but again, I truly believe, and I look at the VIX, I look at consumer, confidence right now and sentiment and everything going on, and I don't think they're pricing this in. This race car is at the red line right now, running. It's got its nose right up into the ass of the next car and 3 cars around it, using that NASCAR analogy. And just one little swerve, one little anything, tire blowout, and that would be the drop in rates. And I can almost guarantee you it will have a cascading effect that will happen fast, or it doesn't happen. So call this doom and gloom forecast and call it whatever you want. Again, every trade I've given you here since I've started this site, I have differentiate between trade setups and actionable trades. In fact, I gave you a setup today. One of my favorite, two of my favorite long-term trades are Broadcom and Nvidia, both crowd favorites. These are stocks that just made, Nvidia not yet, but Broadcom just put in an all-time high. I guarantee you that 99.9% people in the world, including those listening to my voice, have no interest in shorting this stock, probably want to buy it long. And so this is a trade setup. Needs to trigger that entry. Getting a little tight on it here because sometimes, quite often, I'll be honest with you, stocks break out the new highs and they come in and they don't make a perfect back test. Once in a blue moon they do. From my experience, and this has just evolved over the years, with both the man and machine, man being the market makers of yesteryear. Today it's more of the algorithmic trading programs and the trading desk. They know where the stops are, so they'll bring it down a little bit in below 247.88, usually clear out the stops and then go up. However, I set it pretty tight. I could have done a little bit lower, but that's the official entry. And again, take it, don't take it. I don't care. I pass along trade ideas, but the point I'm trying to make with this one and with TLT and TYX, I'm talking about how we're sitting literally on the edge of what could be a cliff that could just crash the markets. Not day one, but trigger. And then if that happens, again, if the breakout happens in long-term bonds, and there's plenty of catalysts out there right now fundamentally that could cause it, or it could make it go the other way, right? Depends what happens. I think in part with Trump's budget bill, in part with China right now in the negotiations. So please hear my voice. That's just a thing to watch for in a setup, and it's also something to react to sooner than later. A lot of my trades, be they longs off the lows or moves off the highs, like QQQ, for example. Remember Liquidation Day? Trump called it Liberation Day. I got a post out to you, we had a level I was watching. I said this will be the lights out level, I think I called it. And he got to the podium, that level was hit. I made a point to post in the after hours session, boom, lights out level triggered. And that was, if you missed it, you blinked. And if you didn't jump on it, that was, I guess, right here, wherever Liquidation Day was, I think was right here. And so that the move came fast. And if you just waited a couple days and said, oh, yeah, wow, yeah, you're right, that was a good sell signal. Well, guess what? You were shorting when I was buying. I was covering my shorts, and it happened fast. And a lot of these trades, and that's what I'm trying to instill in this video, is that we may not break out to new multi-year, multi-decade highs and treasuries. We may just have a little brief pop that then gets faded and comes back in, or not. And the or not part is with every incremental tick higher, once we break out of the recent highs. Again, if you don't have TYX, if you can't chart the yield, then just go to TLT. This is it. And you can see here. And so you watch TLT. And if it takes out the recent low, it's an incremental and almost, what's the term I'm trying to use? Exponential, more so, not linear drop in the stock market. And what I mean by that is, you go 1%, 2%, 3%. The deeper you get down below those lows, the stock market at first will start doing this, and then it'll start snowballing at an accelerating rate. Again, or not. Or maybe this is it. This is where bonds are going to go, and we were testing that, and that's just a great support level, and we go on, we break out above this trend line, these divergences play out. But I think we're going to punch through, I think there's a good chance. But again, you can't bet the farm on it because it hasn't happened yet. Just like Broadcom, you can't, why short it now? Why not just wait another couple percentage, and that level breaks, and it'll likely bring in some of the stops that are set for those that chase the breakouts, the recent breakout to new highs right there. And so, you could short it right now, but you're shorting above support. Remember, resistance, because that was the previous highs right there, right? Resistance, once broken, becomes support. So we're already below the trend line. You could certainly make an objective case to short it on this break of the trend line, and then add a position if and when that goes. And as I said, my targets are offering an extremely favorable risk-reward ratio. If my final targets hit, it's going to be a 63% drop. And all I can tell you is that on this stock, the last 3 divergent highs, this is the third one, last 2, this one had a 31% drop. We were short the market back then and covered everything that morning right there, August 5th, because everything, I mean, just about everything I followed was either hitting its 200-day moving averages or including Broadcom, including NVIDIA, which we were short, were hitting their primary bull market uptrend lines, right? So we covered that. We covered our shorts there after coming off those divergent highs in the market and all things tech. It was not just Broadcom. Broadcom's a semi. Birds of a feather flock together. Then we did it again here. We covered here, but this was a breakdown of that primary trend line, and we got back above it. So I will give it points right there. And that's why I gave you, when I gave you this trade today, I said there's 2 ways you can look at this. Assuming you're even in agreement with me in these charts. And if you're not, then buy it, go long here, buy the breakout. Just maybe use some of these as your stop loss orders. But as I said on that trade, if you might say, Randy, you're crazy. It's stock Broadcom. It's one of the biggest semis. That'd be a catastrophic drop in the market. And if Broadcom goes down, being one of the biggest semis, one of the biggest supplier of chips out there and modems or whatever, it's going to bring the whole market down with it. Yeah, that's in line with my price targets on the the semis are going to fall more than the broad market and more than the NASDAQ 100. They're higher beta, and that's why my targets on my semis are like NVIDIA and Broadcom are more aggressive than my targets on the market. But maybe you don't think that's going to happen. You don't think it's possible or likely. But this would be right here, as I said, T3. If you can see, if I turn off all the levers, that's about 198 right there. Turn off all the lines. And so basically that's just calling for a pullback to the 200-day moving averages, another test of the 200 days, just like we here, and you broke them here, you back tested, rejected. So you may have a differing opinion on where Broadcom's going for me, but you cannot argue. Nobody can argue that the 200s are not a level that both man and machine buy or sell. They buy when you buy pullbacks in a bull trend, you want to buy pullbacks to the 200s, and in a bear trend, you want to sell rallies to the 200s. And then once the 200s are taken out in a bear trend like they were here, then you want to recognize that the 200s are taken out, and then you buy pullbacks to them again. So again, and like any trade, it either plays out or not. And like any trade setup, it either triggers a short entry or not, just like Treasury. So right now, Treasuries the yields are below those previous highs. And so while I suspect, based on this all comes together, the posture of the charts, I'm going to go ahead and move forward now, and we'll wrap this video up. I told you I was going to cover a couple of sectors. XRT. This is the retail sector. As you all know, job numbers came in. They're trending lower. They beat expectations today, but the trend they've been moving lower. So now that's increasing the odds of another Fed rate cut because the job market is slowing down. I commented quite a bit on that yesterday, so I'm not going to do that anymore. We didn't have a big miss on the numbers, but again, we beat expectation, but the expectations were already for a decrease. So keep that in mind. So XRT, I highlighted this trading range here, and we had a breakout last year, and I predicted that breakout, it was a divergent high, as I often tell you, that breakouts that occur, and that was above this trading range, with negative divergence and overbought conditions have a higher rate of failing. And then I gave you That was the breakout there. I gave you 1, 2, 3, 4 price targets. T1 was hit either there. We hit it several times. That was my first target. We wedged up even higher. This reminds me a lot, and that's what the stock market did back then. I was looking for a high in 2024. We made a marginal new high. Then the big drop came. And so we went on down. Again, these targets were laid out way back then. We hit T2. As expected, we bounced. Then we hit T3. And if you recall, again, the morning of the April lows, posted no more shorts, all shorts covered, full long positions. So I expected a bounce off here. And now it's a little stronger than what I expected. We took out the 200s by a little bit. Sometimes you do that, but not by much. And when you look at the technical posture, all I can do is tell you where we're at today. We have this wedge forming. We have negative divergence. Again, just about all the important sectors. Why is this one important? It's not a perfect job of tracking the consumer, but as good as you get. I mean, this is, again, the retail sector ETF. So if consumers are spending money, if they're flush and spending money, then you would think the retail stocks are also going to be threatening to break out to new all-time highs. Well, retail peaked back here in 2022. So, and as a lot of sectors had, so a case can be made, and right now that many sectors, forget about the broad market, the stock market gives a false guise of strength due to the indexing or the market cap weighting. Again, it's a handful of stocks. Again, not my opinion. It's a fact. You can look it up. The vast majority of the returns and the gains over the last couple of years are attributed to just those handful of Mag 8 stocks because of their massive weighting. They're on that unique elite $3 trillion club or $2+ trillion. And so when you look at the rest of the market, a lot of things have peaked back here, especially retail. And as I've said, 70% of GDP comes from consumer spending. So when the consumer's strong and flush, the economy is good. And the consumer's strong as long as everyone has a job, and we're at record low employment. But again, that's been ticking up lately. The acceleration phase hasn't started yet. We had the potential. If today's job numbers missed, I think that would have certainly took the market down. But right now, all I can tell you is we hit T3. We bounced as expected, not only because that was a price target, but because the reasons I stated back then at the time in the market, the overreaction, sell-off, and Trump would cow down, which he did. We got this. So now, just from a pure technical perspective, there is no sell signal, or there isn't a sell signal, to be grammatically correct, on the retail, but it's very, very close. And I believe I have an alert set already. I just set one. That is just like the stock market right now, a textbook bearish rising wedge with negative divergence, but no sell signal. So what does that mean? Well, we can continue up. We can continue to wedge for a while. Anything's possible. We could break down. Maybe it's a false breakdown. I can't sit here and tell you all possibilities because there's an unlimited amount. What I can tell you definitively, that's a very well-defined trend line with a lot of reactions. That's what makes it well-defined. 0 violations and a lot of distinct reactions and negative divergence. Volume's been declining, meaning we're going up on fumes right now. And so I personally have alerts set here on XRT, as well as a lot of sectors, including tech and everything else. And that's it. And so, by the way, I still maintain T4. This is just, I think, going to go down as one of the more powerful bear market rallies in history in the markets. And so I still have these longer term targets I still think will be hit. And but we need to break that level right there. And so if it happens next week, if it happens 6 weeks or 3 months from now, that's a trend line you might want to take note on. And again, I look at everything collectively. Doesn't mean if just XRT breaks the trend line that the whole market's going to collapse. You want to look at the next sector I'm going to show you as well. Transportation. I'm showing you the ones that really historically have been used as a canary in the coal mine, if you will, for the market, or a kind of a guide. the old Dow theory says when the stock market, the Dow is making a new high, transportations and industrial should be as well. If all three aren't confirming, something's wrong. Transportations, goods and services being moved by planes, trains, and automobiles, or trucks more specifically. And so you can see the trannies are lagging right now. They're back testing their 200-day moving averages. Nothing huge. Already broke the trend line that I have here, and at pretty good resistance right now. That was a major reaction high. You had another one there, pulled back, then a breakout, successful back test, but then you lost it here. We've traded through it quite a bit, but there's enough reactions to say that that's a pretty good level. And then finally, to wrap the video up, I really want to cover the financials for you, and then we'll wrap up here. Okay, so XLF. Right now, we all know tech seems bulletproof. Everybody wants tech. Everybody's all in on this AI bubble. And again, it is a self-fulfilling prophecy, or a vicious cycle, really. The more money that, Alphabet has gone all in on AI, as many of the big tech names have, like completely all in, like putting all their eggs, diverting almost all their resources into AI. They're betting everything. Alphabet is either going to make tons of money in the future if it's all that it's cracked up to be and they can monetize it, or the stock is going to just crater when they realize all these billions of dollars thrown at it, and the money's not coming back out of it. But again, that we'll see. Only time will tell. But that's tech, and that's why tech's going up. Here's the financials. So while tech is by far the most important sector as far as providing returns to the stock market, the financials are more of a tell on the overall health, because if the banking system, if the financials break, and remember, if interest rates, like I just talked about in the beginning of the video, if rates go up, typically, I used to be, I was a stockbroker for bank brokerage programs, but I know banking very well. And the core, a crux of a bank, now they have service fees, all this other crap, but basically they make money on the spread. So they like a normalized yield curve. They like when short-term rates are low, which of course the Fed's going to come and cut soon this year, and long-term rates are higher, because that's how they make money. They take your money, you open checking and savings accounts, and they pay you 2-3%, and they turn around and make car loans and mortgages at 5, 6, 7, 8%, right? That's their historic model. And so the bigger that differential is, that's called the spread, the more money they make. However, so you might say, oh, well, shit, Randy, you just said, yeah, Fed's going to cut. If the long-term treasuries break out, that's going to increase the spread. No, because that's going to put the brakes. We already know what's happened to the mortgage market with rates hitting multi-year highs, car loans. And I can go into, and I'm not going to do it in this video. If you want to see it, I will. I track through the FRED, which is FRED, the St. Louis Federal Reserve site. I have all the different charts of the consumer. Consumer loan balances are surging. Delinquencies are trending higher. The consumer is behind. They're just been spending on credit. When COVID hit, they were cash flush because everybody had money crammed down their throat by the federal government. Whether you needed it or not, you got checks, your business got relief. That money's been drying up, and it's evidenced when you go to those charts by the the various Federal Reserve banks. Will show you, and so that's something I'm tracking. And so watch this one. Bottom line, again, I'm rambling about fundamentals. Here's the secondary, the primary uptrend line. This one was very well defined. Here, let me zoom in. Let me just big picture it for you for a second. Financials peaked here with a divergent high. They had DH1 correction, shot across the bow, took out this trend line right here, and I covered it at the time. Breakdown, back test. Made a new marginal new, just like the stock market may or may not do going forward, over the previous high, a marginal new high, followed by a drop of about 20%. Had this explosive rally, everybody, the Trump taco trade and all that, and they realized, oh, it's not as bad as we thought. However, we're still below this more significant primary uptrend line. This is the main uptrend line, primary uptrend line for the October 2023 lows. Nice, clean, plenty of reactions, breakdown, back test, rejection, and almost a near back test again. And we could certainly go up and back test it a little higher. and the divergences will only extend anytime soon, unless it goes up another 15-20%, will still be another divergent high. So again, the same analysis that I'm giving you today, maybe the analysis that I'm sharing, 3-4 weeks from now, if we eke out this marginal new high, if we go up much more than that, we start taking out divergences here on the daily, which will also be taken out on the weekly. This is the weekly chart of XLF. You just extend that line, and you can see it's guaranteed if it happens soon. It has to happen soon. Any new high anytime soon will still be a divergent high and a back test of this primary uptrend line right there. So you had this wedging type situation right here. RSI divergence started there. This is when the PPO divergence started. And this is nothing more right now than a breakdown and a back test, little kickback rally. And so if you want to kind of hone in, this is kind of a meh trend line. It's not as many reactions you can see. Remember, a few weeks back, these were the trend lines I wanted to see broke, and they did break. They broke, kickback rally, hit support where it should have. I've had 49.53 here since 2024. You can see I created that line back on November of 2024. So it's not like a random level I just added. That's where I expected to bounce. It was support. We bounced, and now we've taken out the secondary trend line. Again, it's something to watch. Now what I'm gonna do, and then I'll wrap the video. I'm gonna rifle through, because I've already marked these charts up, about the top dozen or so. When I cover a sector, I always have the components of that sector load. You can see to the right of the chart here as I move my thing over, and I always have them sorted by market cap. So the biggest one, the 800-pound gorilla in the sector, is JP Morgan. It's a $738 billion bank. So as big as that is, that just is dwarfed by Nvidia, $3 trillion, and Microsoft, and those big companies like that. However, I cannot emphasize the importance to the U.S. economy, the global economy, and the banking system of banks like JP Morgan. So when I look at this from a clean lens, when I look at the chart, I see a stock that peaked here with a big divergent high, negative divergence, took out its same primary uptrend line, breakdown back test, and now a secondary back test. And so any high anytime soon will still be a divergent high. Again, if it's anytime soon, maybe something else goes on. We go sideways for a while. But I'm watching this one. This one I don't have a strong opinion on. All I can tell you is we just coming off a back test there. Got rejected, but not very impulsively, and we broke this minor trend line. You can see my support levels. This one would be a big one. I'll mark it right now. Set alert, 251.68. And then, of course, the 200-day moving averages. That's going to be kind of the death blow, I think, for the markets, if and when the major indexes and a lot of these key sectors that I'm covering take out their 200s again. Visa. This one is obviously a kind of a direct insight to how the consumer's doing. And remember, as I said before, consumers are spending, and that's what's keeping the economy up. But they're also spending a lot on credit. Visa makes money obviously from both the swipes as well as the those that don't pay their balance. But I'm going to add another trend line right here, right now, to the Visa. But what I can see from this, just like we had a divergent high here, and that divergent high ended up with a 18, almost 20% bounce. Where to? Was it random? No, it hit the 200-day moving average. Like I said, that's one reason we're covering shorts there and going long. A lot of things were hitting their 200s and some were below above. But this one now has a nice clean up trend line right here. And I do have an alert set on that. I know that. And it also already took out this one. So I had that one first, and I think it was valid. We took it out. Sometimes you break down and you go for a while before you have your first reaction. And it's not uncommon after a breakdown to get a little initial kickback rally. So this would be, and I would encourage you to replicate it, the next sell signal on Visa. And again, this is one of the biggest ones out there. And a lot of these, I'm not going to do it in each and every one. When I look at the weekly charts, this is kind of bigger picture stuff. That was the last divergent high back in 2021. Bear market followed. That was also, no, that wasn't. This is the first divergent high since back there in 2021. So let me go through these. I told you I'd rifle through these quicker. MasterCard, big negative divergence, divergent high, and a nice clean trend line in which to trigger a sell signal. And then you have this primary uptrend line that was briefly undercut during the big drop and regained. So I think it's still valid. Not only that, that trend line also comes in with the 200-day moving averages, which, like so many stocks, that defines a bull market or an uptrend. And it's not uncommon to see a brief dip below the 200s only to see them recovered. So again, any solid break below those 200s, especially with that uptrend line, would be bearish. As I go through the rest, Bank America, again, here's Bank America, one of the largest in the country and in the world, peaked back in 2022, made a lower high. You know, when you look at longer term charts, you know, that so far that's the high, and maybe it'll put in new highs, maybe not. Right now, I can tell you, all I can tell you is it's made a lower high, and if it breaks down here, there's my uptrend line, very well defined. Well, kind of, not very well. It's well enough defined. We had a first one right there, like a lot of them had a trend line one, but we didn't have divergence at that first trend line break. Now, just duplicate that, I've got my beloved divergent high. So we'll see. And again, a lot of these, and there's Berkshire. If you want a long idea, there's Berkshire. I know Buffett just stepped down, and obviously some people were we knew it was coming, so it wasn't a big shocker. The guy was, I think, 98. But there's Berkshire at dual support. Look at that, reaction high. So if you're bullish, there's a trade idea. And not only that, look at that, you got the 200s as well. Double support. However, to me, it's a stock that ultimately is going to break that support level and probably head on down quite a bit lower. But you could certainly make a case to buy it here with a stop somewhat below the 200s down there, about 479 or so, maybe on a daily close or weekly close. Wells Fargo, they just had their restrictions released, and I was watching it that night. I saw the news. It put in a divergent high up here in the post-market. They faded the hell out of that pop. It was a post-market pop up there. Big, you don't see it here because the post-market trades aren't turned on. So it had a divergent high there, and it even has a divergent high right now on a smaller scale. This right here, this is your current divergence. But again, trend line. So here's the takeaway, guys. I'm going to wrap this video up. I'm just clicking through these. Rising wedge, clean up trend lines on a lot of these. American Express, I gave this one to you back here. Would have given it back in January. I gave you 3 targets. I created that back. When did I create that? And just in late December of 24, and I give you 3 targets with a sell signal right there. All 3. That one was hit to the button. You can see that. Move that down there to just put it where it was hit. That was a low of 220.43. Again, I always say cover a little. Oh, it actually went a little bit below that. So either way, perfect tag. And that's what this is. And it was also positive divergence. So remember, that was one of many reasons why I was getting bullish and covering shorts back then when people thought the world was going to come to an end because of Trump's rhetoric. But this one's come full circle, is my point now. That was a major divergent high, big sell signal, counter trend rally. That's what this looks like to me. And now the next leg down will most likely begin when the trend line's broken, then when the 200 days go. And those same targets I gave you before, if I had it, which I did, had them laid out before we even got there, if I thought they were support back then based on these reactions in my analysis of the chart, the fact we had that very, very distinct and powerful reaction off T3 makes it a much more significant support level now. And so if and when 221 goes, that's going to open the door for a much bigger drop in American Express. And that's also going to be a tell on the consumer. You see those big 3 credit card companies, Visa, MasterCard, and Amex, all going down, then that's, the next leg down is underway. Morgan Stanley, Goldman Sachs, divergent high, Progressive. That's it. I'll just wrap up here. I've gone over enough. You get the kind of the gist of it. So in summary, everything I just covered, most of the financials and the big banks are right at on still above trendline support with divergences. Treasuries are still holding below multi-year, multi-decade highs in yields, but within spitting distance. And again, so what I can tell you, I've done this long enough that if treasuries break out, I just told you I have alerts set on all these. I'm going to have alerts going off like popcorn. And again, it can come next week. It may not come for months. Who knows? Maybe it never comes. But if it does, I'll react fast. Engage, aggressively on shorts, start closing out some longs. I've been trading, as a long short portfolio recently. And let me wrap this up here. If you guys want any updates on anything else, let me know. Otherwise, this may be my last, first and only video for the day. Got a long weekend, got company coming into town tomorrow, so want to get an early start on things. This has been Randy Finney with Right Side of the Chart. Have a great weekend.